In 2008, millions of people woke up and realized something was terribly wrong. Their savings were disappearing, their homes were losing value, and for many, their entire financial lives collapsed overnight. This wasn't just a market crash. It was the result of a system that had been quietly building risk for years. To understand what happened, we have to go back to the early 2000s. After the dot-com bubble burst, the US economy slowed down and the Federal Reserve lowered interest rates to stimulate growth. This made borrowing easier, and suddenly millions of people had access to cheap money. Much of that money flowed into housing. People started buying homes not just to live in, but as investments. Prices kept rising year after year, and as they did, confidence grew. People began to believe that housing prices would always go up. Banks saw an opportunity. The more loans they issued, the more profit they could generate. But there weren't enough safe borrowers, so they lowered their standards. Loans were given to people with poor credit and unstable income. These were known as subprime mortgages. Instead of keeping these loans, banks bundled thousands of them together and turned them into financial products called mortgage-backed securities. These were sold to investors around the world and were considered safe, even receiving high ratings. But in reality, many of the underlying loans were risky. Some borrowers had loans with low initial rates that later increased sharply. They believed they could refinance or sell their homes before payments became too high. This strategy depended on one assumption, that housing prices would continue rising. Around 2006, that assumption failed. Housing prices stopped increasing and began to fall. Suddenly, refinancing became difficult, and selling no longer guaranteed profit. Borrowers began missing payments, and what seemed like a small problem quickly spread. Mortgage-backed securities started losing value. Investors panicked, and banks stopped trusting each other. As confidence disappeared, money stopped moving through the system. When money stops moving, the entire financial system begins to freeze. Another layer of risk came from credit default swaps, a type of insurance on financial assets. Companies sold large amounts of this insurance, believing the risk was low. But when the system began to collapse, these protections created even larger losses. Everything was connected: mortgages, investments, insurance, and global markets. When one part failed, the entire system was affected. In September 2008, Lehman Brothers collapsed, triggering panic across the world. Markets crashed, credit froze, and fear spread quickly. Millions of people lost their homes, jobs, and savings. Governments intervened, but the damage was already done. This crisis showed how fragile complex systems can be. It wasn't just about bad loans. It was about a system built on confidence, assumptions, and risk-taking behavior. Even today, the system is more complex and regulated, but human behavior has not changed. Greed, confidence, and denial still exist, and the belief that this time is different continues to appear before every major crisis. So the real question is not what happened in 2008. The real question is whether we would recognize the warning signs if something like this were happening again.